When it comes to the end of the year, there is a lot of bad advice out there about how to save for taxes before the end of the year. And sometimes I see people tripping over themselves trying to buy stuff just to save a little bit on taxes. So, what this video about is today is to hopefully bring a little bit of calm to all the tax craziness and to teach you when you should be spending money towards the end of the year and maybe when you should just hold off. So, overall, I want you to pay the lowest tax amount that's legally possible, but I also want you to have cash in your bank account so you can do what you need to do and make all of your obligations. And we don't want you to be spending unnecessary money at the end of the year. And if you don't know who I am, I'm Hannah Smolinski. I am the founder of Clara CFO Group, and this is the Clara CFO Group YouTube channel. And here we teach B2B service companies how to run more financially efficient businesses and overall how to improve profitability, improve cash flow, and improve overall financial health. So today I want to talk about this concept of end of year spending in order to reduce your tax liability. So there's a lot of bad information out there. And I see sometimes where people will run out to a car dealership, for example, at the end of the year and buy a vehicle for their business. And they'll be like, hey, it's tax savings, so we definitely need to do that. You know, there may be some tax savings to be had there. But one of the big concepts that I want you guys to think about is that if you're buying something that you don't need, then it's not really tax savings, okay? I'm talking specifically to cash basis businesses. So if you run your business on a cash basis, that means that when you spend money, like when money goes out of your bank account, that is considered an expense at that point in time. So if you're an accrual business, that means that you expense things in your business when that occasion actually occurs. So you could maybe pay, for example, your software subscription in December, but if you're prepaying it for January services, then that is actually a January expense, not a December expense. This happens a lot if you get an invoice from a service provider. So let's say you were hiring Clara CFO to do work in January. We invoiced you in December and you paid it in December. If you are a cash basis person, if you're running your business on cash basis, that would be a December expense. But if you were on accrual basis, even if you paid us in December, that would be a January expense. So this concept that I'm talking today about spending money to reduce your tax liability really affects the cash basis businesses. And hopefully there's no accrual based businesses that are doing this too, because it's really not going to help you at all. So let's say that you have heard that, if you spend extra money at the end of the year, you're going to reduce your tax liability. Now, technically, that is correct, because when we increase business expenses, that reduces our profit, which reduces the amount of tax we need to pay to the IRS. Now, that makes sense, right? So if we increase expenses, we have lower profit, and then we don't pay as much taxes, okay? That is all well and good. Now, the problem is that sometimes people will go and buy things they do not need. So they might go out and buy new computer equipment, for example, or maybe they go out and they buy that vehicle I mentioned, or maybe they replace a piece of equipment that was totally fine, but they're like, hey, it's a tax deduction, let's go ahead and do it now. All of those things might be well-intentioned, and maybe, yes, the business could use it down the road, but do you really need it now is the question. Because I want to show you what happens when you spend money just to spend money. There's a potential waste that happens. So if you spend $50,000 on a vehicle that you don't need, and let's say you're able to take all of that as an expense in the year, you work it out with your CPA, you take the right type of depreciation, and you are able to fully depreciate that vehicle within the year. That would reduce your taxable income by $50,000, but your tax savings is going to be the expense amount times your effective tax rate. So in a case of 25% tax rate, that would save you on $50,000, $12,500. So that only really saves you in taxes $12,500, but cash went out the door for $50,000. So then you have a difference of $37,500 that has kind of been wasted cash in some ways. Now, yes, you have a vehicle, but did you need the vehicle is the question. Like, that is where I see some people really getting kind of like mixed up in all of this, thinking, hey, if I spend the money, I'm kind of getting 100% of that money back. And that is not the case. You're getting your effective tax rate back in that. So I think that I want to show you an example of what this looks like. And I don't want you guys to fall into this trap, okay? Now, I love the idea of end of year spending. Okay, so that example I just gave you, I made this little spreadsheet. So 25% tax rate. Let's say that vehicle was $50,000. And you would save that tax savings of $12,500, but potential wasted cash, potential wasted spend is the difference between your purchase amount and your tax savings amount. So yes, you have a car now, but again, did you need that car? So that is my point here. So it's totally okay to do some spending before the end of the year. And I do this for myself, for my own business. And we do it at Clara CFO Group. We do it in Clara Media. But what we want to think about is how much cash do we have available to do something with? And that's kind of where we start, because if you do not have a lot of cash to begin with, and maybe you're cash strapped, you really don't want to be spending extra money at the end of the year just to save a little bit on taxes, because you are taking away that cash and you're only getting a fraction of that back in your tax savings. So I first want you to think about how much cash do I have available? And maybe you look at your cash and you say, hey, we have enough cash. Maybe we have a couple months of operating expenses in our cash account, and maybe we have $100,000 to play with, where we could potentially use that to do something strategic and maybe lower our tax bill a little bit. So what I want to do now is show you a little simple tax planning worksheet that I've put together, and I'm going to make this available to you so you can download it for free. You can go to claracfo.com/tax savings to get a copy of this spreadsheet. And let's hop in and I'll show you what, like, kind of the logic behind this. And again, all of my spreadsheets are for estimating purposes. Like, this is not, I don't know your full tax picture or anything like that. So this is just to help you make a little bit better decisions for yourself and to think logically about, what is best for your business overall. So let's go back to that example where I said you had $100,000 in your business. And let's just say it's the same business, 25% effective tax rate. And let's say you've already paid in taxes, $25,000, and you don't want your cash, actually, let's change this. Let's say we don't want cash to go below 100,000, and your end of year projected profit, let's throw some numbers in here. And let's say you had 200,000 in cash at the end of the year. Okay. So the blue is the input cells, and then you would put in your scenario, and then you have some information that comes out of it. So in this case, we have estimated taxes due of $50,000 on a $200,000 profit. And then we've already paid in $25,000. So we've got a tax liability. Let's say we're in Q4 and we're looking at our estimated taxes for Q4. We've got a tax liability of $25,000 we're going to need to pay. So this is where we go, hey, we've got a little bit of extra cash. Well, a lot of extra cash, actually. We have twice the amount that we feel comfortable, like, really needing in the business. So we have 200,000, and we, don't want cash to go below 100,000. So this is a situation where we might use some of this money to help us save on our taxes. So what I have down here is basically we're going to list some extra expenses we think that the business might be able to benefit from. So let's say that maybe there's some software subscriptions that we've been on monthly, where actually if we go to annual subscriptions, we will save 15 to 20 or 10 to 20%. So it actually saves us a little bit of money, but we just prepay for the next year. So we're allowed to do that in situations where we're not going further than 12 months in advance. We can basically prepay for almost a year of expenses. So if I want to do that, let's say it's HubSpot, for example. Now, I don't know exactly what HubSpot's pricing is. I know it's all over the place, but let's go to HubSpot annual, and we figure out that that's going to be $16,000. And then maybe we don't have a whole lot of other software. Maybe we use Asana, and that's not going to do a whole lot for us, but maybe $2,500 for that. And maybe we go ahead and we pay, like, our QuickBooks, for example. Maybe we can do that annual, and that might be $3,000. And let's see, At this point, when we've done that, this is the amount we are spending before the end of the year. This is all things that we know we're going to use next year. This is things we actually know we like, we use, we're going to want to continue to use that. If you're evaluating different software, you don't want to prepay the annual because that will be wasted. If you end up switching midway through the year, that will be wasted money. So far, that has accumulated $21,000 in expenses. So what that does is it reduces our cash. And what this does is it says, basically projected profit is now lower. It was 200,000, but minus the 21 is 7850, which means that our estimated taxes are now lower, which means the cash needed to pay the remaining amount of tax due is lower as well. So we still got a ways to go. We still have about $20,000 we need to pay for taxes, and we still have some more cash that we can play around with. So I would look at maybe we can prepay rent. So we've talked to the landlord and they are okay with us prepaying rent. So we may look at that, and that's going to be a bigger chunk. Let's say your rent is $4,500 for the year. So $27,000. Now we've spent closer to $50,000 in prepaid expenses for next year. So that's going to mean that next year's profit is going to be higher because we're prepaying these expenses. Okay, so you have to determine if that's what you want. Maybe if you're expecting a lot more income next year, you actually want those expenses to be put into the next year. But under this scenario, we're going to say, hey, we think that next year might be like this year, and why not just go ahead and prepay it since we have the money? We're finding a balance here of paying down some of our prepaid expenses. We've reduced the tax liability a little bit further. Now, we could play around with like, hey, what if we pay, this is like where we can play. That's a great thing about a spreadsheet. No decisions have been made yet. We are just putting things into a spreadsheet. If we made that 12 months of rent, for example, that would bring us up to $75,000 of cash all going out the window. And that's going out to pay next year's expenses. And that's brought our cash needs down to, for extra tax liability, down to $6,125. So that might be a comfortable place for the business owner. That's brought profit down to $125. Now here's another thing you might want to think about. If you are looking to go out for a loan, or you want to sell your business in the future and you want your profit to be looking more favorable, you may not want to be making extra expenses at all. So that's something to think about as well. Maybe you want to necessarily deflate your profit if you're looking for a higher valuation in your business. But let's just say that's off the table. That's not a concern. You're just trying to optimize for taxes. This is an option. So, you might be able to identify a few other things here. Maybe you end up paying like an owner's bonus, or maybe you pay bonuses to your employees and you're able to spend all that money. And let's just put that in here, bonuses. And we're going to make that $25,000. Okay, so now we've spent all that extra cash, and this has flagged because now technically we are under the amount. We're saying don't let cash go below $100,000. So we're at $99,625 at this point. So at this point, we would say, okay, maybe we don't want to do that. But you also, when you're going through the spreadsheet, you might have a discussion with the owners where they say, actually, we wanted to take a draw at the end of the year. And if we wanted to take a draw, for example, like a $20,000 draw for the owners, and on top of all this other stuff, we might say, hey, that doesn't make sense. Let's maybe pull back. We do want to keep the bonuses. Let's pull back the prepaid rent. And we start to get back into a situation that feels a little bit more comfortable. So in this case, maybe then we take Asana out so that we still have all of the cash for operations that we need, and we still feel comfortable about paying bonuses. So that's the power of a spreadsheet. The power of a spreadsheet and a little calculator is you can figure out what is best for your business. So if you want to grab a copy of this simple tax planner, again, you can go to claracfo.com/tax savings to get that spreadsheet. And, just a reminder, don't spend money on things you really don't need in your business. It does not help you, and it does not save enough taxes for it to be worth it for you in the end. So just a friendly reminder from your friendly neighborhood CFO over here. Anyways, grab the tax planner if it's helpful to you. And if this video was helpful, we are building up this channel. So if this video is helpful, share it with a friend. And if you like it, please give it a thumbs up, engage in the comments. All of that will help this channel grow so more people get this important information on how to run their businesses and improve overall financial health. All right, see you guys in the next video. Bye.